Hello friends, welcome to Sundari Mutual Fund's monthly debt market update. The month of October was another volatile one for the bond markets, with the overall trajectory of the rates being upwards. In global markets, the major advanced economic central banks continue to raise the rates to fight against the abnormally high inflation. FOMC in US, BOE in UK, and ECB in Eurozone, all three raised their policy rates by 75 basis points in their recent meetings. The US Fed chair in its delivered a very hawkish statement post the policy announcement and said that it's prudent to continue to raise the rates, though the pace of the rate hikes may slow down going ahead to adjust for the lag in the impact of policy action on the real economy. However, a higher terminal rate may be in the offing. Further, the robust employment data and continued higher inflation print aren't helping the market expecting for a pivot from the Fed. In the domestic economy, the economy remains resilient with economic data indicating towards resilient domestic demand, keeping the growth pace up. This is visible in all the high frequency data and the robust tax collection. The robust tax collection also keeps the fear of fiscal slippage under check. On the inflation front, the inflation data printing during the month at 7.4%, higher than the previous month's print of 7.1%, largely on account of higher food inflation and the adverse base effect of last year. Going ahead, we expect inflation to fall from here and start printing closer to the RBI's projection for CPI inflation, eventually bringing it to within the RBI's targeted range of 2 to 6%. On the policy front, the policy minutes of the meeting held on 30th September were released during the month. In the minutes, the most member agreed and showed concern on the higher inflation and a need to bring the price stability and anchor the future inflation expectation. Some members also showed concern on financial stability, while majority agreed that the domestic demand can keep up the economic growth at a time when the global economy is slowing down. On the future rate guidance, however, RBI MPC seemed a divided house, as two of the non-RBI members of the MPC cautioned against future rate hikes. Notably, Dr. Verma argued that we are quite close to the terminal repo rate, which in his view is 6%, and RBI should take a pause at that level as the policy action impacts the economy with a lag of 3 to 4 quarters. Hence, he suggested that post achieving this target, MPC should take a pause and look and wait for the impact of the previous section in the monetary policy. Similarly, Dr. Ashima Goel also cautioned against the front loading of the rate hikes from here onwards and suggested a calibrated approach towards the future rate hike to see and assess for the impact of the actions made till date on the policy, particularly in a time when there is a lot of uncertainty in the global markets. However, the governor and the deputy governor in charge of the monetary policy cautioned against the risk to the financial stability from the higher global rates and rising dollar. We believe that the arguments of both the non-MPC members, non-RBI member of the MPC seem reasonable about the lagged impact of the policy rates on the economy. However, given the rising global interest rate and stronger dollar, along with geopolitical and climate change risk, we fear that RBI may end up in following the major global central banks in terms of policy rates to keep the financial stability. We expect we expect RBI to raise further, and terminal rate could be around 6.5%. Current market rates also pricing in a future rate hike of anywhere around 50 to 75 basis point in the current market rates. From an investment perspective, we believe that the volatility in the interest rates are going to continue for some time. However, the fact that RBI has already raised the policy rate by close to 270 basis point in the current financial year, and the current rates are attractive for the most investors, we believe that investors with investment horizon of 12 to 18 months or higher can actively look to start allocating money into actively managed short to medium duration strategies or passively managed strategies such as roll down and laddering strategies. At the same time, investors looking for a shorter investment horizon can look for shorter term strategies such as ultra short or low duration strategies. Investors looking to park funds for a very short period can look to invest in overnight or liquid fund. Thanks. With this, we'll wrap this update. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.